Yeah.
Hi, everybody. Thank you so much for joining this afternoon. People are still hopping on the call, so I just wanted to thank you for joining us. I know it's pretty close to the holiday break, so thank you for taking some time to spend with SBIA as you're wrapping up your end of year closeout. So before I turn it over to Dave to introduce the panel and the topic, a few housekeeping items I wanted to mention were that if you haven't yet registered for our virtual Outlook 2021 event, registration is open. That's taking place online
Maybe. So how do
on
we do this again?
January
We gotta
26th.
count the circles.
And please mark your calendars, save the date for our next virtual Capital Links event, which is taking place of April 12th. So it's April 12th through 16th.
Oh, okay.
And we will
yes.
be sending out more information
do
about that and probably opening registration in January. So other than that, and as Brett mentioned, we're planning on having 2 in-person events, June in Chicago and then the National Summit in October in Palm Beach. Fingers crossed. We're looking forward to having a slightly different but still meaningful opportunity to connect with everyone in 2021. So with that, Dave, if you want to go ahead and take it away.
Sure. Thank you everyone for joining the last SBIA LP Council call of the year and my first as LP Council Chair. Those of you who don't know me, my name is David Demeter. I'm an investment director at Davidson College. I help invest the college's now $1 billion endowment fund. Today's call is about what the lower middle market credit opportunity looks like currently. And to discuss that, we have Peter Rothschild of RF Investment Partners and Corey Sklar of Brookside Mezzanine Partners. I was going to let them introduce themselves and talk a little bit about their strategies to start, and then kind of go from there with some questions. And then towards the end, we'll open it up for Q&A from the audience. So Peter, you want to start?
Sure. Good afternoon, everyone, and thank you for having us today. I'm one of the managing partners of RF Investment Partners. We manage $284 million in our fund. Our focus is a little different from many of the other SBIC funds that are out there in that we're doing almost exclusively non-sponsored transactions. So that's not all independent sponsor, where 80% of our deals are direct to companies, typically looking at providing growth capital, providing acquisition financing, providing some liquidity to inactive shareholders, to management teams and owners of businesses. It's what we've been doing for the last 15 plus years. We enjoy doing it. We get significant pleasure from working with those companies and helping them grow their platform. And generally, we're investing between $10 and $20 million. And I guess the last point is we have offices in both New York and Chicago, and then we're opening a Dallas office as we speak.
Hi, everyone. I'm Corey Sklar. I'm one of the managing partners at Brookside. I was going to say Brookside Mezzanine Partners, but as you can see from my background, we actually will have a little bit of a reveal. We're changing our name to Brookside Capital Partners because we think it's a better reflection of the capital solutions that we're providing to our client. Now, we were founded in 2001. We're currently investing in our 4th SBIC fund, which we closed at $375 million of total capital. Different from Peter, where we've historically been a private equity sponsor focused fund. So providing junior capital in the form of subordinated debt, second lien, in some cases unitranche and minority equity, supporting buyouts, recapitalizations, growth capital, and follow-on equity, follow-on acquisitions. We're industry generalists. We have, I'd say we generally target business services, manufacturing and distribution, healthcare services. We invest all over the U.S. Generally companies with 5 to 20 million of EBITDA with a target investment size of 8 to 10 million. We've invested $900 million in 94 platforms since inception. And we have 15 team members, including 4 partners. Our headquarters is in Connecticut, and we have offices or outposts in Boston, Naples, and Los Angeles.
Thanks for those introductions. Just sort of kicking it off, I'm sure in both your respective strategies, deal flow probably dried up in April and months following. Maybe you could describe a little bit about where deal flow is at today, where it's trending, and kind of when it revived, if at all.
Corey, you want to lead us off?
Sure, Peter.
Me or Peter?
Go ahead. You go, Corey.
Okay. Yeah, you're right, David. April, May, it was really slow. We were, just like, all of our prospective private equity sponsor relationships, we were really internally focused, trying to figure out, where each of our portfolio companies stood with liquidity and operations, and just, really fortifying all of those companies. We couldn't even really figure out how we would underwrite a new investment then, just given, the logistical challenges of seeing a business, how we would do that, and then just, the financial implications for each of the, companies you might be looking at. Things really did pick up, though, I'd say in, kind of June into July, we started seeing more deal flow. People, companies that were severely impacted, it was showing. Ones that, had weathered it pretty well were able to demonstrate that. And there was a little better line of sight as to what the rest of the year would hold, assuming the situation stayed the same or improved modestly. And so we ended up closing 3 deals in August, I think, that, we were pretty excited about all of them. And, all 3 were, had limited to no impact from COVID. They were, in unique businesses or niches. And when we, tallied things up at our annual meeting and we were putting some statistics together, for the year, on a trailing 12-month basis, we've reviewed about 335 opportunities against 340 last year. So we're just down, slightly. The only comparable market information that we had grabbed ahead of our meeting was through Q2 overall deal volume, and this was the GF data. There's all different data sources out there, and I take them all with a grain of salt, but they had indicated that transaction volume was down about 30% year over year going through Q2, and I suspect the Q3 numbers are going to show an improvement over that.
Yeah, we're not dissimilar to Corey. I'd say there's probably a little bit of a lag on the non-sponsor transactions, really for 2 reasons. So we saw flow also dry up in late March, April timeframe. We really didn't see a comeback until August. We've seen deal flow pick up dramatically, though, where in 2018 and 2019, we issued order of magnitude 35 to 40 proposals each year, which is really how we track the quality of deal flow that we're seeing. From April until early August, I want to say the number of proposals issued probably came down to 2 to 3 proposals. In the last 10 weeks time frame, we've issued about 14 proposals. So we've seen the significant pickup that I think Corey was referencing in June, July timeframe. We saw it start to take place in late August.
Are many of those transactions coming to fruition, getting beyond, just due diligence and actually transacting?
A number of them are. It's been a little slower. There's still a little bit of a disconnect. And we've seen a number of deals that were going down the path of a change of control, went to market earlier in the year. And then, quite frankly, processes ended up getting pushed. Deal fatigue ended up taking place, where if a management presentation took place in March, April, sponsors wanted to see what would transpire May, June. We've probably seen a half dozen of those processes where the banker and the owner of the business have pulled the transaction and then have come to us and to a few others looking for more of a minority recap maybe take some chips off the table, clean up the ownership structure, but they just got deal fatigue. So we're seeing a number of those deals take place now that were initially pushed into Q2, Q3.
Corey, are on the sponsored side, are you seeing PE sponsors get transactions done?
Yeah, we are. I think, one of the things we've noticed though are, certain businesses, certain industries that, have, not been affected in a big way by COVID, or in some cases, maybe got some tailwinds from it. Those are closing, and, multiples are in line with, 2019 and leverage multiples. So if you look just at a high level at what's transacting and where the multiples are and where the leverage is, it doesn't look a whole lot different. But I think, you've selected down to a smaller universe of deals getting closed. And along the lines of what Peter was saying, we have noticed, even in the sponsored side, a number of deals that, got signed up, based on an assumption about where the business would go over the next, 3-6 months, that it was going to bounce back. And then, as diligence happened and time passed and the companies didn't meet those expectations, deals didn't transact because sponsors either wanted to reprice a deal or decided they needed to wait longer to see where the bottom was, or when the bounce back was.
I've heard from many people in the market that, as describing, that it's bifurcated between activity for COVID affected businesses versus unaffected businesses. Is that your experience? And, can businesses that are affected by COVID get financed today? Peter, you want to take that one?
Sure. Much more challenging. I mean, there are certain businesses, DSOs, for example, that were affected, where dental practices largely, unless it was a specialist, were largely shut down in April and May. Again, depending upon what states the DSO was operating in. So we're largely shut down, but you've seen a complete recovery take place, and you have some visibility from an appointment standpoint. And those businesses have recovered. I think people have been able to get their arms around, how to give credit for a COVID related adjustment. There's some negotiation back and forth what number to use, but those are generally healthy businesses. Anything that at least we've seen that touches the gym space, restaurants, outside of quick service, but travel industry, conference industry, just generally any of those type of events, very, very challenging. We really haven't seen those businesses trade. And just trying to get arms around visibility over looking out and saying, when is a vaccine going to be in place for the masses? What is the world going to look like? How quickly do people return? Does that take place during the summertime next year? Does it take place in the first quarter? How do you change just generally people's habits? Are these more long-standing, or is there a built-up desire to attend concerts, for example, but not knowing when that takes place? It's very challenging for us to underwrite something. We're going to take a more conservative approach with that, and that's what we've seen in the general market.
I don't even think, I'd say maybe in May I saw a couple of restaurant or, gym type of things in the market, or, late April, that were, needed capital. They were in the, and we're trying to raise some probably rescue capital then at the front end before you kind of knew the full effect. And I haven't even seen anything in the market. Like, I don't even know if anybody's asking for money for those kind of businesses right now, because they really would be hard to finance.
And truthfully, I think Corey and I both run levered SBIC funds. And Corey's a close friend and someone, quite frankly, who's been a bit of a mentor over the years for me, as he's considerably older than I am. But for SBIC funds that are levered, we're both in it to hit singles and doubles. One wants the leverage to work for us. And so what we told limited partners, I'm sure what Corey told limited partners, we're not looking at home run situations, be extremely opportunistic. where we could get into a 4 or 5 times type situation, but at the same time, there's a higher chance of losing capital. And so I think we're generally known in the marketplace that we're just not going to invest in those types of situations. Corey, would you agree?
Yeah, for sure. I mean, we're always shooting for mid-teens returns on our investments, and and if you look, historically through the 94 investments, we have a few outliers that did much better, and we like those, but we're not underwriting to that.
For businesses that have been somewhat impacted, like DSOs or other types of businesses, are terms in your favor? Is capital a little bit more scarce for them? Can you drive terms a little bit better? Just both pricing and other.
I don't know. We actually have. This is a little bit, stepping into Peter's world a little bit, but we have a deal. I don't know if we'll end up doing it or not, that we're working on right now. That's a dental. It's not a general dentistry practice. It's more of a specialty practice, DSO, and it's a little bit on the smaller side. It's the beginning of a buildup, but the purchase price was negotiated with a COVID holdback, and it's a pretty substantial amount of the cash, being held back pending the business getting back to sort of an average monthly run rate for 12 consecutive months that was equivalent to 2019, so kind of pre-COVID. So it's structuring around some of that, and this would be a unitranche facility where we priced it at double digits. There's no senior debt. I mean, we're looking for security and safety in that structure in a business that fundamentally we believe that the long-term, prognosis and thesis is solid. I mean, these practices have been around for many years, but we don't know what the next 12 months holds, and they could be shut down for 2 months, and we may have to go get through that.
Yeah, I would agree with Corey. For us, flexibility and creativity right now, and largely creeping up the capital stack so that there's little to no senior debt ahead of us on our situations is incredibly important. And quite frankly, we're still getting and seeing more mezzanine pricing, even where there may be little to no senior debt ahead of us.
Now, do you see any, from your perspectives, and I know you're looking at very specific strategies and deal flow, but is capital scarce at all? Are there particular sets of banks, or in the GFC, banks pulled back quite a bit, allowing other lenders to come in? Are banks or other traditional lenders still out there lending as frequently? Or is there a gap that you can fill?
Do you want to start, Peter?
No, please.
Okay. I think capital is still abundant. I wouldn't say it's scarce. I think banks are way better positioned than they were during the Great Recession. Their balance sheets are in much better shape, but they're still banks, so there are limits to how aggressive they'll get on new deals. But we are seeing a lot of bank activity, leverage loan activity in new deals, as long as the leverage multiple isn't climbing too high. We're seeing probably the most competition, though, from unitranche. We are in our world. I don't know, Peter, it might be a little bit different, but particularly on sponsored deals, there's a lot of aggressive unitranche out there from, and it seems like, I feel like I'm hearing a new name every day, of a fund that I didn't know existed, that's got, billions of dollars behind it. We have, a portfolio company that has done, we've been in it since 2014. They're doing a big acquisition. The leverage right now is like 2 times. So it's way under levered, the base business, and they're looking to use the balance sheet to make this acquisition. And we were hoping to stay in, and we were trying to find some partners to come in and upsize what we think is a well-priced security, there's some issues with, the company is somewhat cyclical and there's some things, but they went out to market with a Lincoln process and got term sheets in, and our pricing is 13%. They got unitranche pricing to go right back down to our last dollar at L plus 650 to L plus 800. And, it's hard to compete against that in a situation like that. So there's definitely aggressive capital out there for some situations.
Hey, Corey, are you seeing that bifurcated by size of company EBITDA wise, or are you seeing
Yeah,
that?
probably. I mean, this is a big company. Pre-COVID, it was kind of 18 million of EBITDA. Right now it's down to 14 or 13 and they're buying 5 or 6. So, on a combined basis, it's going to be a $20 million, call it, EBITDA business.
Yeah, we've seen a pretty big difference between quality of the company that's out there and the size of the company. For certain businesses in certain industries, in particular for recurring revenue model SaaS companies, where if it has a certain size, there are very aggressive lenders out there chasing it. For more EBITDA leverage businesses, as much as 10 million of EBITDA used to be the threshold, I would say that's even come down to 7.5 million of EBITDA. Where we see more opportunity and where we play is more in the 2.5 to 7 million of EBITDA. We still see pretty significant opportunity there. That's where we've seen the BDCs pull back fairly significantly, using the bullets that they have with the best sponsor relationships that they have, and not focus on non-sponsored deals. In the hottest marketplaces, we find more traditional lenders come into the non-sponsored world. When there's a pullback, that's where we see a pullback take place, again, in the lower middle market non-sponsored arena.
Well, thank you for that. PPP loans, obviously, were going out the door in April. Do you think has PPP delayed any borrowers' demand for capital? Has it, created any barriers or changes to really anything you do?
Not for us. I mean, I think, our companies that got PPP, we probably wouldn't have wanted to put those dollars in at the time that the PPP came in anyway. So, we viewed that as, if it's forgiven, it's, kind of equity going in, or if it's, if it's not, then it's low cost, cheaper debt than ours. And, so it hasn't changed our view or behavior, I don't think, in any way.
The only thing I would add to what Corey was mentioning is that, for our borrowers who took PPP loans, the average size PPP loan was probably $1 million. We had everything from $400,000 or $500,000 up to about $3 million, right, in size. But when looking at the size check that we're looking to write in transactions, 10, 12, $15 million, $1 million PPP loan is not going to affect their needs.
I mean, with continuing travel restrictions, has that been an impediment to getting new deals done, doing due diligence or sourcing?
Corey, you probably have an easier
Sorry, I'll start saying names after every question. Corey, you want to go for it?
Sure. Yeah, it's been a challenge. I think, early on we were trying to figure out, how do we close a deal if you don't go see it? Can you close a deal if you haven't seen it? And I think we're still, we're of the mind we want to, we have to go see it. But, we can do all of our upfront work, before we go out there and actually, lay eyes physically on it. And, just where we're at in travel, I think, we're generally more comfortable with precautions if we had to travel. We haven't done a lot. We've closed just a couple of deals since COVID started. One of them we didn't visit because it was with a fund that was, that had owned the business already for 5 years, that we knew well, and we relied on that. But the other ones we did day trip out to see. And, we're not making, and it's one person, and, we're not requiring, junior people to travel. It's the partner goes, looks at it, make sure it's what it's supposed to be comes back.
I think we have to be very creative in the current environment. We're not forcing people internally to travel. Our team is traveling, or certain members of our team are traveling. You know, one of the issues, quite frankly, especially in New York, is the quarantine issue. So if we leave state and have to come back in quarantine for a certain amount of time, and how that affects, quite frankly, with children at home and their ability to go to school and whatnot, there are additional complications with that. But we have 4 of our team members have been traveling. I've driven up to Boston several times. I've driven to Maine several times. We had a CEO fly into New York to meet with us. So it's all about, you know, being creative right now. We won't do a deal unless we have the opportunity to meet with management and spend time together. Too much takes place outside of a 3-hour Zoom call of just getting to know the partner. My suggestion would be I would have never married my wife if we hadn't met in person. And I feel the same way with the companies in which we back.
Good to hear. Peter, is this the best vintage year for SBICs that are levered? You know, the venture rates are around 1%. You know, how impactful is that on prospective returns?
So I guess let me just make sure I understand the question. If it's a 2020, 2021 vintage year fund or investments made in 2020, 2021?
I guess both. Just the ventures are low. You know, you're borrowing in tranches as you go.
I think we have a tremendous opportunity right now. From my standpoint, we're borrowing where the debentures are, you know, less than 1.5%. We don't change our pricing on transactions based on where the debentures are currently priced. We think that there's tremendous opportunity in the marketplace to find situations where we're able to creep up in the capital stack, playing more of a traditional unitranche role, still get mezzanine pricing, and we try to invest equity in the majority of our transactions and structure that equity as either convertible preferred or participating preferred, where again, our last dollar of risk is not going very deep and there's significant common equity cushion behind us. The challenge, quite frankly, is the marketing challenge. Because where we are traveling for deals and for portfolio companies, we're generally not traveling actively for marketing reasons. And even where I have a colleague today who's went from, I guess tomorrow's in Charlotte, today is in Austin, and was Monday and Tuesday in Nashville, had 4 meetings get canceled. And part of it was 2 of the children of the people with whom he was meeting had COVID, someone got cold feet, and fully understand that. But so much of our marketing takes place in person. We can certainly send out announcements, we can make phone calls, emails, but again, it's a relationship-driven experience, and making sure people know the type of transactions that we're working on is critical. Zoom calls are terrific, but it's just not the same as sitting down face-to-face, having lunch, having coffee. You know, people schedule back-to-back calls and are looking at their clock saying, all right, I've got another call starting in 5 minutes, I need to jump. People don't do that when you get together with them in their cities and meet for lunch or coffee.
Yeah, I mean, for us, it's, you know, I do think this fund will be, you know, our fund 4 that we're investing out of now that we have a lot of uninvested capital is a great time for us to be investing out of that fund. That we were, you know, again, in our annual meeting, one of our slides shows debenture rates in 2001 versus now, and they were about 6%, I think, when we raised our first fund. So that's a lot of extra yield back to limited partners. But you know, our model's a little bit different, and you know, I think we can take advantage of it in maybe a little bit of a different way than Peter, because it is, you know, we had to take some time to get used to the marketing in this new environment. But you know, because we're marketing primarily to private equity sponsors, you know, we know a lot of them already. So a catch up on Zoom is a great way to just, you know, kind of stay top of mind. Attending some of even the ACG or the SBIA conferences on Zoom, where there's breakout rooms and ways to network. You know, it took us a little while, but I think we're hitting our stride on that as well. And and for a fund like ours, we kind of look at a couple of the drivers of returns will be velocity of investing, putting the money to work quickly and having a big funnel, and then preservation of capital. And if you do those two things, you can really benefit from the low debenture rates and the leverage on the fund.
Thank you. I'm running out of questions, so I just want to give everyone a heads up. If you have questions, I'm going to open it up for Q&A in a little bit.
David, can I ask Corey a question?
Yeah.
What do you see as the refinancing risk on many of your situations? As you talk about putting money to work in a timely manner, how do you model out refinancing today versus where you would have done it 12, 18 months ago?
That's a good question. I mean, when we generally assume, like when we raise the fund and we model out, what we think our returns will be, we use a 3-year duration on our investments for the most part. I think that's always a challenge for us. Our fund 3, which we're now in the outside of the investment period, in the harvest period, that was a $260 million fund, but we made $460 million of investment out of that fund because of, the redemptions and the reinvestment. So we have to probably be more active than you do, because because we are investing with private equity sponsors, and they're pretty conscious of maintaining as efficient a cost structure and capital structure as they can. And when the time comes that they can refinance us out, they will. You might stay in a little longer in your deals, I'm guessing.
We try to. It's interesting on the debt transactions. We've had a few debt only that have been refinanced early for us. Where we're investing equity, which again we try to do in almost every deal, we have a put on the equity, so that if we get refinanced or if more than 80% of our debt comes back to us, we can put the equity back to the company, which on those situations really allows us to stay in longer, which is nice.
That's good to know. We usually, I think when when we're doing those kind of deals and we have a put on the equity, we usually tie it to just a year, year 5 or whatever. But I kind of like the way you tie it to the refinancing risk. I'm gonna copy you.
We generally don't get pushback, but again, these are non-sponsored situations. With the mentality that most of our teeth comes through the debt.
Yep.
And so being naked on the equity is something that we have the option to do, but that we don't want to be forced in that situation. Sorry, David.
No, I appreciate it. So far, I haven't seen any questions come in from the audience, but yeah, if anyone has any questions, please feel free to unmute and ask away. If not, I'll give Corey the opportunity to ask Peter a question, just to be fair.
All right, am I up? I guess that's it. Peter, how come you haven't showed me a deal to share yet?
Because your credit standards are too high for me. No, in all seriousness, I mean, as I think everyone on this call probably knows, the SBIC community, we're very fortunate to be an SBIC fund. It's a very tight-knit community. And so Corey and the folks at Brookside have been very kind to us. We've looked at a number of transactions that may not be true sponsored deals in the past with Corey. Finding like-minded individuals when we do a deal, we don't want to spread thin and co-invest with 10, 20 different groups, because you don't know how someone will respond when things don't go as planned. But there are a handful of folks that we have the utmost respect for, and certainly Corey's one of those individuals.
Thanks, Peter. I'll send you the money later.
I tried to invest in your fund, Corey.
True. Well, I feel the same way about you, Peter. Appreciate it.
Well, I guess we're wrapping up. We have a question. How do you see Melinda's asking, how do you see the fundraising environment? It seems like there's a lot of demand, but not seeing a lot of groups in a face-to-face environment is a challenge.
Yeah, I mean, we're we're probably, we closed on this fund in April of 19. So, we probably won't be back, seriously on the fundraising trail until, 2022. So I'm probably don't have much to say, although I would imagine it's challenging if we weren't able to have face-to-face meetings.
I'll tell you, and David, you know this, my 2 cents is that there's certain GPs in the world who look to begin conversations with LPs when it's time to fundraise. From my perspective, that's the worst thing that you can do. If you make a phone call to a potential LP and they haven't heard from you in the last 3 or 4 years, and you have your hand out, it's just a bad way to approach a conversation. What we've been most successful with is making sure we've got full communication when we're not actually fundraising. And so, and there's a few folks on this call who I hope would agree with the statement by us, but we're always fundraising, even when we're not fundraising. David has been extremely helpful, and Will Hodgson, who's on this call from Michigan, and a few others, but in helping us make sure we're being good fiduciaries, not just putting the money to work, but making sure we're fully communicating to our LP base and fully communicating to others who are not currently part of the LP base, but that we'd like to develop a partnership over time. And at least what we've tried to do is make it less transactional. If someone chooses to invest in our fund when we're fundraising, great. If they don't, it's a small world. We'd love to continue the relationship, and who knows what takes place in the future and if things line up. But we want to make sure that you can measure us by what we told you 3 years ago or 5 years ago. Does the story match up? And if so, great. We'd love to continue to further develop our limited partner base. And if not, I'd love to be called on it as well.
Great. Well, I don't see any other questions. I'm gonna call it. It's the last one of the year after all. Thank you all for joining, and thank you to Corey and Peter for giving us your observations for the year, and really appreciate it. Thanks for joining.
Happy and healthy holidays, everybody.
Likewise.
David, thank you. Alex,
Thank you all.
Guys.